normally, if you want to understand where global markets are heading, you look at interest rates.
Yeah, right.
And if you want to understand the tech sector, you look at silicon supply chains.
Exactly, yeah.
And if you want to understand digital assets, you watch what the early adopters in Wall Street are doing. But today
Is a totally different story.
Yeah, today the value of your portfolio is effectively being decided by, well, a smoking crater in the Persian Gulf.
It really is.
You are living through an absolute collision of all those forces at the exact same time. I mean, it is March 19th, 2026. Okay, let's unpack this. We're looking at a catastrophic 24-hour stress test on the global economy. We've got physical warfare, complete monetary policy paralysis in the U.S., and this is the crazy part, a radical rewiring of the plumbing beneath global finance, all crashing into each other on the exact same day.
Yeah, and we really have to stop looking at these as, isolated incidents in separate news feeds.
Yeah.
What you are witnessing right now is a structural, unavoidable realignment of global capital flows. I mean, the established post-war geopolitical consensus, that fundamental assumption that global trade, energy, logistics, capital markets would just smoothly operate.
That's just gone.
It has entirely fractured. What we're left with is a highly entrenched regime of stagflation.
Exactly. And our mission on this deep dive is to guide you through how all of this actually connects.
Right.
We're going to decode how the physical destruction of Middle Eastern energy infrastructure has essentially trapped the Federal Reserve.
Which is huge.
We'll explore how that panic triggered a violent wealth transfer from the earliest crypto pioneers straight over to Wall Street. And we'll get into how, despite all this macro chaos, blockchain architecture just quietly became the official plumbing of the Nasdaq.
It's been a wild 24 hours.
So let's start with the catalyst, the actual kinetic spark. We just saw a highly destructive Israeli airstrike on Iran's South Pars gas field. And the immediate Iranian retaliation was completely unprecedented. I mean, I was reading through the reports, and they didn't just hit back at military targets.
Well, not
They went straight for the economic throat, utilizing ballistic missiles and drones against non-combatant Gulf states.
Which completely shatters the illusion of regional containment, right?
Yeah.
They actively expanded the kinetic footprint to fundamentally disrupt the global energy supply chain.
Right. And rather than just rattle off a list of targets, let's actually look at the scale of what was hit. We saw direct strikes on Qatar's industrial zones.
Including Ras Al-Ain.
Exactly. Ras Laffan, which houses the world's largest liquefied natural gas and Pearl GTL plant.
Just massive facilities.
Over in the UAE, civil authorities had to execute emergency operational shutdowns at the Habshan gas facility and the Bab oil field. In Kuwait, suicide drones successfully struck the Mina Abdullah and Al Amadi oil refinery.
It's a systemic degradation.
And right in the middle of this absolute chaos, U.S. President Donald Trump issues a social media ultimatum threatening to, quote, massively blow up the entirety of the South Pars field,
while explicitly disavowing any prior knowledge of the initial Israeli strike, which is
wild, right?
Yeah, it highlights a profound breakdown in allied military coordination. But more importantly for your portfolio, we have to look at the underlying mechanics here.
Right.
This is not just a political conflict. It is a permanent thermodynamic shock to the global economy. I mean, historically, upstream energy extraction zones operated with a sort of unwritten geopolitical immunity.
Because everyone needs the oil.
Exactly.
Yeah.
You could fight proxy wars, but you didn't bomb the refineries. Well, that immunity is gone.
Yeah, totally gone.
The immediate reality of this targeted infrastructure degradation is severe. We saw Brent crude futures surge past $115 per barrel.
Wow.
That's a 60% price appreciation just since late February. And fears over disrupted LNG shipments sent European natural gas benchmarks spiking by 30% in a single trading session.
It's like, okay, think of the global economy as a car driving down the highway. The Federal Reserve has been riding the brakes, meaning keeping interest rates high, trying to slow down the vehicle and get inflation under control.
Right, the restrictive policy.
But this destruction in the Middle East, that is like the road suddenly turning into deep mud. It doesn't matter how hard the Fed presses the brakes now. The friction is external, and they are basically losing control of the vehicle.
That's a great way to put it.
So walk us through the mechanics here. How does burning oil in the Gulf mechanically force the hands of central banks?
Well, if we connect this to the bigger picture, the Federal Reserve is trapped by the data. I mean, the Federal Open Market Committee just concluded their meeting, and they held the federal funds rate strictly at 3.50 to 3.75%.
Which was expected, right?
It was.
Yeah.
But the true signal is in their updated dot plot projections. 14 out of the 19 Fed members currently project 0, or at most only 1, rate cut for the entirety of 2026.
But wait, I want to push back on that for a second.
Sure.
Because historically, Chairman Jerome Powell usually ignores temporary energy spikes. Like, if oil goes up because of a localized conflict, the Fed typically says, we don't print oil, we print money, and they just look past it.
Right.
Why can't he just look past this one like he always does?
That is the exact dilemma they're facing right now. Powell actually explicitly addressed this during his press conference. They usually do try to look past transient energy shocks, but the core problem here is that their progress on reducing underlying goods inflation had already stalled before this attack even happened.
Oh, great.
They had to aggressively revise their 2026 core personal consumption expenditures, their preferred inflation gauge, upward by 30 basis points to 2.7%.
So it was already sticky.
Exactly.
Right.
Because the baseline inflation is already sticky, injecting this massive targeted energy destruction into the supply chain acts as an absolute accelerant. If they lower rates and inject liquidity now, they risk triggering an uncontrollable inflationary spiral. So they are mathematically locked into a higher for longer restrictive regime by necessity, not by choice.
And we really can't ignore the severe institutional friction occurring at the exact same time. I mean, the apex monetary authority of the United States is operating under extreme political duress right now.
Unprecedented duress, yeah.
We have this ongoing Department of Justice investigation into Chairman Powell regarding cost overruns for the Fed's headquarters renovation.
Right.
And the chief judge, Boasberg, just issued a ruling stating there is zero evidence of a crime. He explicitly suggested the probe appears engineered by the Trump administration to illegally pressure Powell into lowering interest rates.
Yes, and that political pressure is cascading straight through the legislative branch.
Yeah.
You have a key senator currently using his committee position to essentially blockade the confirmation of Kevin Warsh.
Who is the nominated successor to the Fed chairmanship.
Right, insisting he won't let it move forward until this DOJ inquiry is resolved.
Which led to Powell issuing an unprecedented ultimatum. He stated he will serve as chair pro tem, essentially an acting chairman, if Warsh isn't confirmed by the statutory deadline of May 15.
He's flat out refusing to vacate the Board of Governors.
Right.
And this raises a crucial question for any macroeconomic allocator, which is, what happens when the central bank of the global reserve currency is operating under political siege while simultaneously fighting a stagflationary energy shock?
Right. Where does the money go?
Exactly. The fundamental institutional instability surrounding the fiat architecture is exponentially increasing the long-term utility of decentralized, non-sovereign settlement networks. Capital always seeks a sanctuary when legacy systems fracture.
But, okay, if the Fed is trapped and legacy systems are fracturing, let's look at the immediate market reaction to this engineered stagflation, because the price action in digital assets over this 24-hour window was violently downward.
Very violent, yeah.
We saw Bitcoin drop from an open of around $73,934 down to an intraday trough of $69,500. That's a roughly 5% drop that absolutely wiped out leveraged long positions, especially after a hotter-than-expected PPI print hit the wire.
Yeah, the algorithmic market makers and quantitative trading systems, they recalibrated their risk models instantly. They saw the escalating Persian Gulf conflict, they saw the hawkish Fed data, and they just executed a massive wave of volume-backed selling.
And the institutional rotation was just as brutal. I mean, we had this 7-day streak of positive net inflows into U.S. spot ETFs, pulling in $1.16 billion. Wall Street loved it.
They couldn't get enough.
Right, but then suddenly the momentum violently inverts, and we see a severe $129 million single-day outflow. Let's pause and explain how that actually works, because an ETF outflow isn't just a red number on a screen. It physically moves the market.
Exactly. The mechanics of that outflow generate profound downward pressure on the spot market. Because of how these specific ETFs are structured, they require strict physical settlement through entities called authorized participants, or APs.
Okay, so how do the APs work in this context?
Think of an authorized participant like a highly regulated bouncer at a very exclusive club. When institutional clients panic and want to cash out of the ETF club, they hand their shares to the bouncer.
Right.
The bouncer then has to go into the back room, grab the actual underlying cryptographic collateral, the physical Bitcoin itself, and liquidate it directly onto secondary order books to get the cash to pay the client.
Wow.
So when traditional macroeconomic allocators get scared of Middle East tensions and start treating Bitcoin like a high-beta tech proxy, their rush to the exits forces massive mechanical selling pressure onto the actual asset.
But the contrast in participant behavior here is what I find so compelling. While traditional finance allocators panic and hit the sell button on their ETF wrappers, the original network participants, the true early adopters, are deliberately cashing out.
Yeah, the on-chain data there is fascinating.
Right, I was looking at it, and these aren't just Wall Street guys selling. We tracked one massive legacy whale wallet address, starting with BC1Q ending in the 6 annular, that has been around since 2013. That early adopter just dumped 1,000 Bitcoin onto the spot market for about $71.6 million.
Though they did retain about 1,500 Bitcoin.
Right, they kept a bag.
Yeah.
But at the exact same time, you have other early investors like Owen Gunden liquidating 650 BTC for around $46.3 million. It's like a massive changing of the guard.
It really is.
The pioneers who built this space are cashing in their chips and dumping their floating supply right onto the order books of Wall Street institutions.
That is a highly accurate assessment. I mean, you look at the crypto-quant exchange whale ratio, right? It spiked up to 0.83 during the panic before settling at 0.66.
And what does that ratio actually tell us?
It proves that highly capitalized early adopters are driving these exchange inflows. They're looking at the transient geopolitical risk premium and deciding, hey, it's a good time to exit historical positions.
Right, take some profits.
Exactly. For the broader market, this is a highly painful but fundamentally healthy redistribution of network supply. The ownership is systematically transitioning from individual cypherpunks toward regulated corporate treasury frameworks.
Which brings us to a really fascinating contradiction. Because if Wall Street is dumping their Bitcoin ETFs in a panic, you would think traditional finance wants absolutely nothing to do with crypto infrastructure right now.
You'd think so, yeah.
But the SEC just did something that proves the exact opposite.
What's fascinating here is the absolute bifurcation of the technology's maturation from the short-term spot price action. You really have to separate the volatile asset from the underlying architecture.
Right. We just saw a landmark regulatory milestone. The SEC formally approved Rule SR Nasdaq Q 2025-072. They are allowing eligible, highly liquid traditional securities to be traded as blockchain-based tokens directly on the Nasdaq order book.
The magnitude of this cannot be overstated.
Really?
Oh, absolutely.
Yeah.
The SEC is legally permitting a dual-crack parallel market structure. These tokenized equities will integrate directly with the Depository Trust Company, or DTC, to achieve T+1 settlement.
So trades settle in one day instead of two, utilizing cryptographic rails.
Exactly.
But let me get this straight. They aren't embracing the decentralized part of crypto, are they?
Oh, no. Not at all.
They're essentially stripping blockchain of its permissionless ethos just to upgrade the efficiency of their own legacy monopolies.
Precisely. The SEC demanded strict integration with the NBBO, the National Best Bid and Offer.
Okay, break that down for us.
Sure. The NBBO is the regulation that ensures you get the best available price when you buy or sell a stock across different exchanges. By requiring this strict integration, the regulatory apparatus is actively preventing liquidity from leaking out into off-exchange decentralized finance venues.
Ah, so they're keeping it contained.
Exactly. They want the incredible efficiency, the speed, the auditability of cryptographic settlement, but they want it domesticated within the heavily regulated walled garden of Wall Street. The underlying architecture pioneered by these networks is systematically consuming the operational back end of the Nasdaq.
But, if the underlying tech is taking over Wall Street, why are pure-play crypto operating companies struggling so much right now? I mean, Kraken just indefinitely froze its massive initial public offering plans.
Yeah, that was a huge signal.
They pulled the plug because of all this macro fear. And we just saw a newly listed peer BitGo suffer a massive 44% stock collapse. Yet, at the exact same time, corporate treasury holding companies are thriving. Why the massive disconnect?
It comes down to how traditional equity markets price risk in a stagflationary environment. The current market ruthlessly punishes any crypto company that relies on traditional equity sentiment or retail trading volume for its operational funding.
Because the retail volume dries up.
Exactly. But the market actively rewards aggressive corporate proxy entities, companies that simply hoard the asset on their balance sheets. Traditional equity investors who are constrained by their own institutional mandates are willing to pay a massive premium for liquid equity vehicles that act as dedicated cryptographic treasuries.
So they want the raw scarcity of the asset without the operational overhead of running an exchange or a custodian.
Exactly. Just look at Evernorth Holdings. They just filed an S-4 to execute a $1 billion SPAC under the ticker XRPN.
Right.
Their explicitly stated objective is to build a massive treasury of 560 million XRP. Or look at American Bitcoin, ticker ABTC. They formally disclosed their corporate reserves expanded to 6,899 Bitcoin. The strategy is clear: bypass the risky operating models and just aggressively accumulate the mathematically sound collateral.
Okay, here's where it gets really interesting. Because while the software layer is being tokenized by Wall Street and accumulated by these massive corporate treasuries, the physical hardware layer, like the actual machines that secure this scarce collateral, is facing a completely different monopolistic threat.
Yes.
And it all traces back to artificial intelligence.
The reality of securing a decentralized network requires immense physical hardware. And right now, the global silicon supply chain is heavily skewed against cryptographic operations.
Let's look at the Q2 earnings from semiconductor giant Micron Technology. They posted an explosive revenue beat of $23.86 billion, driven entirely by insatiable enterprise demand for AI memory. Everyone wants AI chips.
Right, it's a gold rush.
But the crazy part, Micron's stock actually dropped 6% after hours. Why? Because management announced a staggering $25 billion in capital expenditure for 2026, plus another $10 billion in 2027, just to build the facilities required to keep up with the hyperscale cloud providers.
And if we connect Micron's massive capex back to the digital asset space, the relationship is just devastating for crypto miners.
How so?
This insatiable AI demand is monopolizing global foundry space at manufacturers like TSMC. When a chip manufacturer decides what to build, they look at margins. High-margin AI chips are immensely profitable right now, which means they are actively squeezing out the fabrication of the highly specialized SHA-256 ASICs required to mine Bitcoin.
Man, the pain in the mining sector right now is acute. We track this metric called hash price, which is basically the daily paycheck a miner gets for a specific unit of computing power.
Right, per terahash.
Exactly. Right now, hash price has collapsed to roughly 3.4 cents per terahash per day. It's incredibly weak. And because miners are struggling to stay profitable, the secondary market pricing for efficient, sub-19 joules per terahash hardware has plummeted 23%.
Down to what, $15?
Down to $15 per terahash. People are dumping their machines.
This thermodynamic reality mathematically guarantees massive consolidation. When hardware supply is squeezed by AI monopolies and your profit margins collapse due to macroeconomic fear and geopolitical energy shocks, independent, small-scale operators just cannot survive.
They get washed out.
Exactly.
Yeah.
Only publicly traded corporate entities with massive balance sheets and, crucially, access to sub-cent power generation can weather this shock. The decentralized network of independent operators is rapidly pivoting into an oligopoly of highly capitalized enterprise data centers.
So what does this all mean for you? When you zoom out from the chaos of the last 24 hours, a very clear, albeit sobering, picture emerges. Between the targeted destruction of energy infrastructure in the Middle East and the absolute paralysis of the Federal Reserve, a structural regime of stagflation and fiat debasement is mathematically locked in.
It really is.
The transient ETF outflows you see on the news, the localized dumping by early whales, that is just short-term liquidity noise.
The true signal for any allocator lies in the structural realities beneath the price action. It is the structural integration of these decentralized networks into legacy equities, empirically proven by the Nasdaq tokenization approval. And it's the relentless accumulation by corporate treasuries.
And that leads to a final, entirely different kind of thread to mull over. If the physical hardware layer of this network is rapidly consolidating into massive, highly capitalized enterprise data centers, and global sovereign conflicts are currently proving they will ruthlessly target physical energy and industrial infrastructure to win wars. Well, how long until sovereign states realize they must not only mine this mathematically scarce collateral, but physically militarize and defend these hashing data centers as critical matters of national security?